You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo, beaming to you from the Options Insider Radio Network HQ, where we produce many fine programs, including many hundreds of episodes of Volatility Views. And where can you find all those great back episodes with great conversations and guests and debates and discussions and listener questions and all that fun stuff? Well, of course, the easiest place to grab it is just the mothership of the flagship of the OptionsInsider.com. Click on the Insider Radio Network tab, top left corner of the page, and you're pretty much good to go from there. You can download, you can stream, you can make comments, you can do whatever tickles your fancy while you're listening to these programs. And of course, you can also surf around the site, click on the other articles, analysis, education, unusual activity, etc., breaking news from the options market, all sorts of fun stuff for you guys to find there. And if that's, of course, too much work, you can't be bothered to use a desktop browser, even a mobile browser anymore, just surf on over to the iTunes store, indeed, wherever you find your favorite podcast, and grab the content there, or just grab our mobile app and sit back and let it all be spoon-fed to you. Whichever way you like your content delivered, we make it available for you. And, of course, we'd love to hear from you guys. If you have questions or comments after or during the programs, shoot them out over. We love to hear from you guys. Twitter, Facebook, email, however you like to get us, we're there as well. And joining me, speaking of someone who is not here but still on the program today, he's beaming in from Sin City this week. You know him, you love him as the Greasy Meatball, Mr. Mark Sebastian, from myriad different dalliances. He does some stuff on the network. He moonlights over there at Option Pit. Even got a new gig cooking over there these days. Mr. Greasy Meatball, welcome back to the program. How's Vegas treating you?
Vegas is the best. Good to be here, guys. Glad to be around, and thanks for having me. Was here for the Trade Winds conference, and enjoying trading around. And doing a little table gambling yesterday. Playing Vegas volatility, as I like to call it, and it was a decent night.
What's your table game of choice?
I'm a blackjack.
Oh, okay.
Blackjack, and a common misconception is that blackjack is all about playing the odds. It's as much about money management as it is about playing the odds, and the key is to manage your money when you're trading. Beyond just blackjack.
All right, listeners, and also joining us, a bit of a blast from the past, even though he has been on the program a few times since then, our old co-host, my old volatility compatriot, coming back for another turn at the old table, Mr. Don Schlesinger of VolX fame himself. Don, welcome back to the Volatility Views program. Sir, it has been far too long.
Well, it's always great to be back, Mark. Thank you very much. And I've missed you guys, but I've been listening to almost all of the shows. And when I get a chance, I write in with a comment or two. But it's great to be back live.
And really quick, we had Mark just updating us on his new venture. Give us a quick update, and a lot of people are always interested in what you guys are up to. Give us a quick status update on all things Volex. Where do you guys stand? When are we going to be able to trade these things?
Well, I'm hoping that we now see the light at the end of the tunnel, and it's looking like the first quarter of next year. We already have a signed agreement with BOX, with the Boston Options Exchange. They are going to list real vol options on SPY, on the Spider contract. And we are in negotiations with a major exchange to list our futures on the SPYs as well. So as soon as the ink is dry and as soon as all the approvals are in place, we will be ready to go. We're really hoping to get going in the early part of 2016.
Well, that's good. That's good news. I know for a lot of our listeners out there who've been asking, hey, what's up with the Volex guys? People always write in asking about you guys and some of the other ones out there. I've said many times, the underlying kind of a key sticking point. Glad to see you're close to getting that worked out. And speaking of working things out, it's time for us to do that in the vol world. It's time to dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome back to the Volatility Review. This is indeed the portion of the program where we break down what's moving, what's shaking, what's rocking, what's rolling in the world of volatility, trading, analysis, research, all of that fun stuff. We're recording this on Friday, October 16th. For all of you playing the home game, we're about midway through the session here today. And unlike some of our other recent sessions this week, this one a little bit more undecided, a little bit more unched. Earlier sessions this week, it has been pretty much rocking and rolling to the upside for most of the week, when you, of course, have seen a continual erosion, implosion, call it what you will, out there, an implied volatility, as well as the underlying continues to rally. We're hovering about 2026 in the S&Ps right now. Of course, VIX Cash volatility continues to erode. We had pretty much a 10-day or close to it pronounced downside streak out there in VIX land, which is pretty much the longest such streak we've seen since 2010, October of 2010. You remember not that long ago we were talking about, wow, we're just how many days of upside can we have and how many days over 20 will the VIX Cash have? Or now we're on the other side of that coin. In fact, as we're recording right now, listeners, we're south of the 16 handle in the VIX Cash. So things are indeed eroding at an impressive clip. That has more than a few people perhaps a little bit alarmed out there. At the same time that VIX is eroding, of course, skew out there, depending on which metric you're looking at. If you're looking at the CBOE skew index, it is exploding, hovering right now right around 151 or so, which if you're familiar with that index, you know is pretty much a record high. You got to go back a long time to get stuff even close. You got to go back to October of last year to get into the 140 range or so. But looking beyond that, these are pretty much astronomical levels we're hitting here. So it's kind of a weird confluence of events we find ourselves in these days. We see a VIX eroding at a pretty much a record clip at the same time that skew is popping off at a record pace. So it implies perhaps people selling at the money ball, buying tons of out of the money ball. It's a bit of a weird scenario, a lot for us to sink our teeth into. Don, since it's been a long time since you've been able to join us on this segment, we'll give you pride of place here. What's been catching your eye amongst this whirlwind of volatility, not just over the past week, but maybe over the past few weeks or months, because it's been a while since you've been on?
Well, of course, the phenomenon that you just mentioned is not really all that unusual. And what has happened, of course, is the market has rallied. We've had a very strong October, and with the traditional very strong negative correlation between VIX and the actual market movement. As the market has rallied in October, VIX has sold off dramatically in response. But we're also told that those are the very times when the market starts to get if not a little bit frothy, because we started for some pretty depressed levels, but at least starting to look a little bit healthier. This is the time when traditionally people start to worry a little bit more when the market is climbing and when VIX is dropping. So that's when you start to see this skew index perk up a little bit as people start to think that maybe yet again there will be another sell-off, and they start looking at the out-of-the-money puts for protection. In terms of realized volatility, it was just about 4 weeks ago, almost to the day, that we hit a recent high of just over 31 for trailing 21-day volatility. And as I just checked it a couple of minutes ago, as of last night's close, we were down to the 17 handle. So that's a drop of 14 on 31, or almost 45% in the last month or so. So again, not surprising to see VIX following along. VIX is certainly not oblivious to realized or actual volatility, and with real vol down 45%, you certainly would expect a kind of a coming along of VIX in the same manner.
So listeners, if you were playing score at home, it was about 4 minutes in before Don mentioned realized volatility. So those of you on the over-under on that, I believe it was the under. On 5 minutes was where it was going. But that said, you bring up some good points. I'm looking at the numbers here while you were talking as well out of the SPX in terms of the actual vol out there. And you're right, things are rocking and rolling. 30-day actual realized vol out there, about an 18% right now, which is for at least for the past year in like the 82nd percentile. So fairly heavy, but not record levels. But you get a little bit farther out, 60 days. That, of course, encompasses all of the maelstrom of August and all the craziness we saw there. You're talking about 22%, which is pretty much pinning the needle at the 100th percentile there, top of the charts. Doesn't get much heavier than that, at least not for the past year, certainly. And getting even a little farther, even 120-day, which is a crazy long time period, you're still up there about a 17.3, which is also, again, pinning the needle. So looking back a little bit, SPX, and indeed the market has been rocking and rolling for some time now. Mark, a lot to sink our teeth into here. What's been catching your eye out there in the volatility landscape over the past week?
Yeah, one of the things, to Don's point on skew and kurtosis and things like that is, generally speaking, when volatility falls, skew increases because it's the wings where people kind of continue to hedge themselves. And people have short-term memories, but not that short. And I don't think a lot of people liked what happened to their portfolios in August and to a lesser extent September. I have to say that I've been a little surprised we got to 16 this fast, despite the drop in realized volatility. I'm a little surprised we fell like this, just because the vol of vol continues to be high. VVIX is near 100, and skew. People continue to kind of be scared. The Federal Reserve still keeps opening their mouths. I guess the nice thing, the big change is that the Federal Reserve has now lost 100% of their credibility as opposed to only about 80%, which is what they had prior to August. And the market basically says, we're going to tell you what you should be doing because you clearly don't know what you're doing. And I think that's why we've seen the market kind of volatility fall and the S&P recover the way it has.
No, I definitely agree with both of you. This is kind of what we expect to see when the underlying is rallying. You see skew get steeper, just maybe not this steep this quickly. People are clearly out there gobbling themselves up some out of the money protection. Again, we've talked about some of the nuances of the skew index in the past and why perhaps you can't read too much into those numbers, but it hasn't stopped a lot of people from ringing the alarm bells that apocalypse is on the horizon. And when you're getting those kind of alarm bells, Mark, there's pretty much only one place you need to look Those are our good friends over there at Zero Hedge who never met a catastrophe they didn't like or a tinfoil hat theory they didn't mind espousing. And they've been on a bit of a tear of late, Mark, when it comes to really diving in to the VIX and what's been going on out there and using it to set up. Well, the title alone of one of their more recent articles, listeners, should give you a bit of a hint of what they're on about. It's Supernormal VIX Swings. I'm sorry, Moral Hazard, Supernormal VIX Swings, and why August 2015 was just an appetizer. So if that's not a typical Zero Hedge headline, I don't know what is. But what's interesting about this, Mark, is it's not just them going off on a limb on some interesting but esoteric tangent. They're actually pulling in some actual data. They're citing our good friend Chris Cole, who's been on the program in the past. Hasn't been on in a while. Maybe we'll have to bring him back on to discuss some of this. But taking some of his research, and I think running with it is the loose term to put it. Let me pull some of the choice quotes out of this article. They say central banks refuse to let volatility remain elevated, but this is creating a new set of shadow risks. Global central banking has artificially incentivized bets on mean reversion. Again, we talked a lot about the mean reverting properties of volatility. He's saying the banks are essentially incentivizing that type of betting. Modern volatility markets know that global economy is facing inflation. The single most important unknown is for global central banks, whether or not they're actually going to withdraw their support of the markets. They get into moral hazard. He comes on to say, or they come on to say in the article, the pattern is creating a monster of short volatility that, if left unchecked, will contribute to a repeat of the May 2010 flash crash or 1987 Black Monday. August 2015 was just an appetizer. A lot of people sent us in this article, Mark, saying, hey, what do you guys think of this? I know came across this. I came across it, all of it, kind of everyone at once. Everyone wants to know what we think about this. So this is a fun one. I know this one's been kind of swirling around in your brain for a while now. So I'll give you first crack at it. What's your take on this and some of the more, shall we say, exotic claims coming out of this article?
It's a little ludicrous. Blaming the Federal Reserve for everything seems to be like every amateur's. I don't think Chris Cole's not an amateur, and so blaming the Federal Reserve for kind of this type of mean reversion, I think, is a little amateur-y. I think I'd labeled the email, "When did Chris Cole buy a tinfoil hat?" Because it just a little ridiculous. I'm interested whether how this was plucked and what the status of their letter was, because they do some interesting things, but recall their whole approach is volatility correlation, and maybe the correlation model is breaking down and they're looking for an answer. When something doesn't work, the Federal Reserve is a great recipient of blame for a lot of people. So I'm interested whether that's where they came from, because as I look at it, yes, there's central bank action, but really, this was as much about, this sell-off was as much about failed central banking and mixed messaging as it was about central bankers stepping in. And so I'm not so sure that I agree with any of the major points made in that piece.
Yeah, this is kind of a good example of citing some good and reliable data points and then perhaps building a less supportable argument around that data. Some of the things they cite here: the VIX is experiencing epileptic seizures. I like their terminology. I gotta love Zero Hedge for that, including erratic and violent outbursts up and down at the most frequent pace in history, as new sources of structural short convexity interact with interventionist policy responses to crisis. The VIX has registered a quantifiable, quote, supernormal. This goes back to, I think, Chris Cole's data, where he likes to define those events, which they define as 5 standard deviation plus up or down moves every 3 months over the last 2 years. And in July to August 2015 alone, we experienced the single largest multi-day draw up and drawdown in the history of the VIX index. Again, so these are some reliable data points that they're citing and then taking them to some perhaps less reliable conclusions. Still interesting stuff. Don, I know you haven't had too much of a chance to chew this over, but I know Chris, you were on the show when we brought him on in the past. You worked with him in the past. He's not a typical tinfoil hat kind of guy. What's your take on some of his claims here, as well as where Zero Hedge has taken them perhaps to the next level?
Ironically, Mark, it might very well have been that I would not have seen this. And ironically, just I guess it was 2, 3 days ago, I got an email from Bob Kraus, from our CEO. We constantly exchange articles about volatility of any kind and academic works. We try to stay abreast of everything. And he said, this is an awfully interesting piece by Chris Cole. You should read it. And when I opened it, I said, oh my God, this is like 30 pages with all these incredible charts and research. And my first thought was, how long did it take him to create this? It's really an extremely impressive piece of work.
It is a dense piece of work with a lot of images.
You know, whether you agree with the premise or not. And believe it or not, I actually waded through it, and I read almost, the entire thing. You got to skip over a little bit here and there when it's 30 dense pages like that.
Yeah.
But as I was reading it, in addition to my first reaction, which was, wow, this is really impressive research. My second one was, gee, we had Chris on as a guest at least twice when I was on the program, and I didn't remember this side of him.
Yeah, this is like, perhaps a new Chris.
To Chris in the year or two that I've been away.
Don, my guess is that he got beat bad, and he's looking for a decent answer. I don't know, Chris. I don't know what the returns of Artemis are. So this is just me just taking a stab. The other piece is that, VIX futures. The interesting thing, the only piece that I thought was kind of an interesting point was the way VIX futures didn't track VIX. But the piece that he kind of forgets is that the September future had just become the front month future when this whole thing ran off. And September was close to 30 days to expiration following that VIX pop. And anybody that thinks that a one-day move from 28 to 53 is not going to revert back into the 30s has never seen how VIX moves.
Sure.
So that's part of the reason why VIX did what it did. The interesting piece is that, if you track how VIX futures moved, VIX kind of steadily dropped. And really up until the last week before September expiration, that September future rallied and rallied and rallied and rallied and rallied because of kind of, we stayed in a volatility range. But, I don't think that's a Chris Cole type of thing. I'm just really interested in how he came to this premise and where it came from. We got to bring him on. And I don't want anybody to think that I've seen his returns or anything that he's done. I don't want to. For all we know, he absolutely killed it in August, and he actually is just kind of, or his researchers are just that into, into thinking the Fed, that central bank intervention is causing this thing. I don't know, but just having met him in the past, he didn't seem like a Bitcoin type guy. Let's just put it that way.
Yeah, I kind of have a hard time because I came to it first through Zero Hedge, so before I saw his letter. So it's kind of I want to make sure I separate the Zero Hedge part from the Chris Cole part. I don't want to unfairly label him with one or the other because we know, as we said before, Zero Hedge, the guy posts under the Tyler Durden handle, so they're throwing some fire bombs into the room just on purpose. But that said, it's interesting stuff. In fact, as I'm sending an email to him as we speak. To bring him back on the program because I think there's a lot to discuss here. And some interesting, Chris is great at pulling up some very interesting data, and there certainly is a lot here. In fact, listeners, I encourage you to not just read the Zero Hedge piece, but really go to read Chris's investor letter yourself. You can kind of take a deep dive into all that data we discussed, all the charts and everything else. So there's really a lot to sink your teeth into there. We could probably do the rest of the show on some of this, but interesting stuff. And I want to definitely get Chris on to explain or discuss his point of view of this. And maybe he is indeed wholeheartedly in support of this and perhaps indeed attributing the Fed for driving mean reversion Interesting stuff. We'll have to wait to hear from him, but interesting stuff as we move on. Some of the other things that have been catching our eye over the past week from a vol perspective. We are indeed in week 2 of the great VIX weekly option experiment, trend, call it what you will. It certainly seems like they are out of the gate running. We talked last week on the show, Mark, as it was breaking, as we were recording the show, a big trade went up in VIX. It was about 30,000 contracts, VIX Weeklies, I should say. Now we're seeing them doing more robust volume, and I believe actually yesterday, a 15,000 lot of the ACA weekly 15 puts going up. So they seem to be doing some size, certainly more than any other appreciable near-term volatility product we've seen launch recently, aka VXXT and its ilk. So they seem to be doing all right. I'm looking here again today, and it seems to be some paper going up on them. Not a ton today, but earlier this week, certainly they were rocking and rolling. Don, it's been a while since we've seen a new volatility product launched. I'm curious what your take is on this weekly product, and the fact that because it is focusing on the nearer portion of the volatility curve, does that make you more intrigued in it? As I know you have your views on VIX as a tracking vehicle, but when you get a little bit closer to home, it may be a little bit more compelling to you, or do you not really? This does not interest you at all?
No, it does interest me, and I know you're gonna think I'm putting in a plug, but there's a method to my madness. When we will launch real vol futures, we are going to have consecutive weekly expirations. Now, that's not to say that we aren't going to settle to 21-day realized volatility. The settlement will always be based on the previous 21 trading days of realized volatility, but rather than having to wait monthly for serial expirations, we're going to offer 52 of these a year so that, when people want to make bets on volatility, they can jump in at almost any time and have a new calculation period ready for them. So the concept that VIX would expire weekly, certainly I endorse, and for many, many months, even before VIX announced this, that's how we were configuring and planning to do ours. But having weekly forecasts, is just a little bit different. Like we will never settle a volatility contract to a week's worth of volatility, and that's simply because this is a standard deviation calculation. And when you're doing it by formula, you're using a certain amount of data points. There are listeners who may be familiar with the concept of how much is sufficient to make a decent comment about a standard deviation. And in mathematics, it's generally agreed that that should be a minimum of 20 data points. So when you're calculating this by formula, you really are great to have, 21 trading days in a month, and that's sufficient and adequate to make a statement about standard deviation or volatility, but surely 5 days worth really isn't, and we are not now, or probably never will, plan on offering that kind of a product. VIX is a little bit different because, as everyone knows, VIX is a forecast and not really a calculation of anything, and therefore, if every Friday you want to round up a new forecast of what future 30-day volatility might be, I certainly don't see anything wrong with that, and if the public wants to trade it, I think that's perfectly fine.
Yeah, Don, the same thing. I think that the idea of trading what the next month will look like every week makes a lot more sense than trading volatility on how much a week is moving.
Yes.
And so, I do think that they found a better spot, and they've developed a better product than their original, the original VXST. I think this makes more sense. It's more targeted, but it's also a more standardized contract. VIX is kind of what a market on variance, if you will, and having I've never heard of a 9-day variance swap trade in the history of mankind. at least 30 days trade, a 30-day swap trades now and again. And it makes a lot more sense to me. And a variance kind of calendar, which is what a VIX future is, those trade as well. And so, they're back into something that actually has some sort of semblance of a prior marketplace. Interestingly, Don, I was sitting down with Jeff Gibby of Metastock yesterday, and we were kind of talking about realized volatility because he wants me to develop some indicators for Metastock, and my main basic one was, I said, well, do you guys run a Garch calculation? And he goes, what's Garch? And I said, oh, Don, the angels of Don Schlesinger cried from the heavens.
Hey, and Mark, I got to tell you something. You're going to be excited if you haven't looked at the website in a while. It's not up yet. We're simply announcing it. But in addition to Garch, which we used to carry on the website, and of course is the work of Robert Engel at the Volatility Institute at Stern Business School at NYU here in New York, we have been in contact with two rather well-known academics. One of them is an Italian researcher by the name of Fulvio Corsi, and the other is extremely well known in the United States for many of his volatility papers and his book on the volatility surface, and that's Jim Gatherall at Baruch. And each one of them has developed independently forecasting models not only to rival Garch, but from everything that we have seen in doing the regression and the R-squared and the mean error, the smallest squares, the least squares errors, tremendous forecasting tools, which Jim calls rough vol, and which Fulvio calls HARK, H-A-R-K. And so we are going to carry those models free of charge on our website once our products launch as a reference tool for traders who might want to get a handle on what these forecasts of future realized volatility will look like. And I have to say, we're very impressed with their work.
Interesting stuff. I'm looking at the website, listeners. It's volex.us. If you haven't been to it in a while, not .com, it's .us, and they have all the fun gauges and all the things we talked about there many times, including, of course, a lot of that great research. Sounds like more stuff coming down the pike very soon, so we'll stay tuned for that. And we did go a little bit long on that zero hedge discussion, but that always is the question. We'll hit on a few more things before we get a chance to welcome you guys into. I want to get to that skew discussion as well. So some quick rundowns of what else is cooking in the world of vol. Bit of a relatively a decent week from a vol perspective in terms of volume out there in VIX options. A few days like the 13th, really lighting it up. 1.2 million contracts out there in VIX options land. The rest of the day is hovering decent volume, 600,000 to 700,000 most days. We did see some interesting paper too, perhaps no doubt as a result, perhaps of this protracted sell-off reduction we've seen out there in volatility. There's been a lot of put love out there of late, in particular yesterday. Looks like a pretty sizable just could have been closing. There's a lot of open interest on that strike, so it's hard to really determine. Kind of a really well-executed mid-market. It looks like put buys kind of across the board. These 15 puts, we mentioned the OC weekly puts going up also about 15,000 times, and also the Nov 15 puts going up about 15,000 times. Most of those, looks like all of them actually paper buying. There's some other paper floating around out there that kind of obscures it a little bit, but it seems like just paper gobbling up some puts out there, which is interesting. We don't see that very often out there in VIX land, even particularly out there when we're hovering in the mid-teen realm. We're not in the mid to high 20s anymore when people were seeing puts as a little bit more of an attractive prospect. We also saw some size verticals, OC 2124 going up about 17,000 times, paper buying that earlier this week as well. In terms of what's locking out there, total about 9.5 million contracts open out there. So things getting pretty robust out there from a VIX options perspective, about 6.25 million on the calls, about 3.35 million the puts. Like I said, also some other products out there exhibiting some vol of late. We talked last week, Mark, about your love for some flies out there in gold, particularly the way the skew was shaping up out there with the wings catching a bid out there in terms of that old volatility smile creeping its way back into gold. Gold's been kind of vacillating around quite a bit. We've seen that skew vacillating appropriately as well. And now these days, it's still, this week, still straight up smile. So Mark, how are those gold flies working out for you?
Super well. It's been it's the gold moved. Let's put it that way. It made a quick move from about 109 up to almost 114. GLD did, and gold itself made a stab at 1,200. So that stuff got super bid, and gold moved. So they've since dropped the volatility a little bit and flattened the skew, which makes sense. But gold running around a little bit. And, it may keep doing that because obviously dollar is king. It's just a weaker king than it was a few weeks ago.
Yes, that is indeed the case. And in terms of the other product out there that's been exhibiting some vol of late, we talked crude last week. Crude's had this kind of love it, hate it dance with the 50 handle of late across both products pretty much, and kind of on the loving it side last week, then getting back towards the hating it side again, and kind of vacillating in between. We've seen a crude vol coming off across most of the major measures this week as well. The OVX, OIV hovering around the 42 level this week, which is a little bit down even from last week's level. They were hovering around the 45 level or so last week, kind of continuing this narrative we've seen out there almost ever since, I hate to keep harping on it, but ever since that Goldman report of buy vol now, we've seen nothing but vol erosion out there for the better part of the past at least few months out there in crude. Again, looking out here, volatility skew wise, it seems like once again the bias, the love, the concern out there on the downside, with still a fairly heavy bid out there leaning towards the puts. Not perhaps quite as aggressive as last week, but still out there clearly not the smiley love we see out there in gold, but definitely directional concern out there in the crude stuff. Don, before we get to our other segments, anything catching your eye out there in the shiny stuff volatility, in the Texas tea volatility, anything catching your eye out there in the commodity landscape you want to share with our listeners?
Nope, haven't been following it all that closely, so I'll take a pass on that one.
You're dyed to the wool S&P vol guy.
Well, we're just so saturated with it for right now that it's where we're concentrating all of our efforts. But the time will come where we're going to branch out into so many of these other assets, and I may have something to say about that just a little later, and an actual new website that talks about the various indices and risk measures that we're contemplating.
So, Don, I was actually, I didn't get to finish kind of my little statement, what I was talking about earlier. Intuitively, I've got an idea, and I want to know whether you've got any thoughts on this. I had this idea that when we see ultra low realized volatility, and you tell me whether I'm wrong. All right, you're going to say I'm wrong, but when you see ultra low realized volatility, does ultra low realized volatility beget low realized volatility, or do you think that points toward kind of a bottoming and movement increases at once that happens? What are your thoughts on that?
So I will tell you my thoughts on that, and this goes along with the Garch models and with both what seem like contradictory concept of what is called auto-correlation or serial correlation, as well as reversion to the mean. When you see very recent low actual or realized volatility, if you're trying to forecast what that might beget, there are these two components that seemingly play against one another. One of them is your knee-jerk tendency to say, this is much too low, volatility reverts to the mean, and therefore I'm surely going to predict higher volatility to come. But all of the modeling for future volatility, Garch or the other models that I spoke about, more heavily weight the recent volatility than they do the more distant volatility. They don't throw away the more distant volatility, but there's an exponential weighting for the recent past. And so that argues for a persistence of the low volatility regime. And that argues for saying that this may stick around for a while. So those two ideas really kind of go hand in hand. And what happens is the forecasts say we're going to go higher because historically we know that this regime really can't last. But at the same time, we are going to forecast still a kind of a lower volatility regime simply because that's what we've been having for a while. And, you know, I always kind of give the temperature type of thing. When you have sub-freezing temperatures and, 10 days in a row of 0 to 10 degrees, you don't suddenly forecast 40 degrees because, eventually it has to go higher and you have to revert to the mean. You say we're in a cold snap right now, and if I'd have to predict for next week, maybe I'll go up to 15 or 20, but I'm not going to go up to 40. So it's these two concepts that play together when you try to make those kinds of predictions.
And Don, Mark just reminded me we haven't had a chance to get your opinion on this, shall we say, controversial product. I know we want to get to our discussion. I'm not sure if we'll have time for it now, but I'm sure you'll have some viewpoints on this as well. This is, of course, the much discussed, much debated VIX up, VIX down product, and kind of you were around when they initially started mentioning this, and what they sold it as was as a way to, of course, try to let retail try to avoid some of the nuances and difficulties of dealing with that VIX futures term structure. We've seen what it since has come out into the marketplace as. It's now presenting itself as a way to, quote unquote, really try to trade that VIX cash. I think there's some interesting viewpoints on whether or not it has delivered on that. I'd be curious to hear your thoughts on that. I'm sure you have quite a few.
Well, I haven't actually followed the numerical, the actual trades to see whether it's delivered, and either one of you may actually know that in reality how it's turned out, but theoretically, when Robert Whaley came out with his discussion of it, we all kind of had a reaction as it's not going to happen. It's just not going to happen. It can't happen that way. You're not going to be able to create a trading product that is, in fact, going to mimic the index. You're going to have ridiculous arbitrage opportunities that can't and shouldn't exist. So I think you guys have probably followed it since its launch more closely than I may have, but I'm just going to sit here and guess, say that we're probably right and that it didn't work.
So Don, right now, the stock is trading, let me get you the finalized price. Right now, the stock is trading $2.09. What do you think the split adjusted opening price is now? Just take a guess.
That's hard to say.
Give me your best guess. This will be fun.
I don't know.
It's $267. So it has lost 99% of its value since list, and and that includes that August pop. Now, there's been weird dividends and stuff like that, but that VX up is a disaster. And here's the best part. Let's look at VX down. So VX up, absolutely murdered, right? How do you think VX down is doing? Let me put that in perspective. VX down is now trading, it is trading $2.30. You know what its opening price was? I'm sorry. Folks, this is just high comedy. $223. So whether you were betting on VIX going up or VIX going down, you lost.
You got to ask yourself, if we get to the discussion of the reader's letter and skew and how it was before the crash of '87, I'll have a quick story to tell about Leland, O'Brien, Rubenstein, and portfolio insurance. And the question you always ask yourself with these things is, these academics who should certainly know all of the math and then who come out and ballyhoo such a product, you have to ask yourself, is it really possible that they didn't understand that this was going to happen, that they were that naive, or did they really kind of deep down know that this wasn't going to work, but somehow or other they got behind it anyway? I don't propose to know the answer to that, but it sure as heck always fascinates me.
Since you alluded to that, let's dive right in because we're coming up against it here. I want to have some time to discuss this. Without further ado, let's dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, listeners, well, welcome to the Volatility Voicemail. This is indeed the portion where you guys get to take the reins. If you listened last week, Mark and I had a great discussion regarding this listener question that came from Agave. He wrote, hey, is it true that Volatility Skew was born out of the 1987 crash and didn't exist previously? I heard that recently. It seems difficult to believe. Mark and I both said pretty much that it did, or at least that was the confluence of where it became a mainstream discussion phenomenon. You know, I've heard of a few people, Mark had said he talked to Shelley Natenberg, who said they were working with things that were skew-esque at the time prior to 1987, but that seems to pretty much be the inflection point that everyone really talks about when skew was born. As soon as we got off the show, I thought about 18 million things that we could have added to that conversation, as it always does, but we ran out of time. Then Don sent us a great discussion point. I thought, who better to have on the program today? Don, we always love having you on anyway, but who better to have on the program today than someone who can actually give us a bit of that practitioner's perspective of what was going on from a skew research and trading analysis perspective during 87 and prior indeed to 87. So Don, I know you have a lot of thoughts on this one. We're kind of running up against it, so I'll just toss it to you, sir. The floor is yours.
Mark is always the master, what's the word that I'm looking for, flatterer, because he could have said, who best to have on the program but somebody old enough to have been on the desk.
I would never say such a thing, sir.
God, it's hard to believe that it was 28 years ago. But in any event, I was on the desk and had been for about 3 years prior to that. So about 31 years in the industry or so. And of course, yes, it actually was true that nothing like the skew that people know today existed prior to the crash. Instead, it was called a smile. And the reason for it was very simple. For the vast majority of the strikes, everything except extreme out-of-the-money puts or calls, both sides, implied volatilities were virtually identical, up or down, either side. Didn't matter if you were 5%, 10%, puts, calls. The line was relatively flat. Where it turned up was perfectly symmetrically on both sides at the very, very extremes for such far out of the money puts and calls that these, if modeled with the Black-Scholes model, would have been practically worthless, practically 0.00, maybe worth a penny, maybe worth 2 cents if you use the same volatility as all the others. Well, you couldn't buy an option for 2 cents. The smallest increment was a 16th. People used to call it a steenth or a teeny, okay? And that was 6 1/4 cents. Or the next increment, the next tick, an eighth, 0.125, 12 1/2 cents. And so these options had to have, regardless of what a theoretical model said, at least the value of a 16th or an eighth. But the model said that they were worthless. They were worth a penny. They were worth 2 cents. So naturally, you had this upturn at the corners, left and right, because in order to get them worth 6 or 12 cents on a model, you had to keep cranking up the implied volatilities, making them higher and higher until the model finally said that the option was worth 6 cents or 12 cents. Person who brought me into the industry, I can't quote what his exact words were. The listeners will have to infer a different verb, but he used to jokingly always like to say, anybody will pay a teeny to watch the monkeys play. Only he didn't use the word play in what he said. And so basically what he was saying was, anybody will pay a 16th for a lottery ticket and take a shot at a crash, a black swan event, a tremendous rise, something to the upside, some explosive market movement. And so this created what anybody today would say would be the bottom part of a smiley face. You didn't have the two eyes, but you had the mouth that looked exactly like a smile. And that's what everybody called the smile of implied volatility. And then
John, I got a quick question for you. And I've thought about this. So there wasn't skew, all right? So back in the 80s, would I have just cleaned up collaring a portfolio all the time because I would have been able to collar for free?
Well, you would have been able to do things symmetrically, except for one thing, which you're probably not quite thinking about, and that is interest rates were astronomical at that time. And interest rates actually got to like 14, 16, and 17%. And so the forwards were such that you really did not have the symmetry of the strike prices because it was assumed that the underlying would always appreciate at the risk-free rate, and so the same percentage strike call was always more expensive than the out-of-the-money put of the same. So you could have collared
for a huge credit all through the 80s.
Yeah, they were really some wacky kind of opportunities. So now comes the demise of portfolio insurance, LOR. Telling people that they just sell futures on the way down, and this is a dynamic way to hedge your portfolio. And of course, nobody told the people that when you most needed this kind of protection, it stopped working because when you're driving your car over the cliff, it's a little bit too late to try to negotiate an insurance policy. And if you don't have that signed, sealed, and in the drawer before you go over the cliff, you've got a problem. So there was a tremendous outcry of people who got burned and lost huge amounts of money. And everybody came to the realization that there's really only one way to protect a portfolio from a black swan or from this type of a crash that we had, 23% down in one day, and that is to own out-of-the-money puts as protection, where you're 100% certain that they will pay off and that you have them in place before the event takes place. So there was, in one single day, the smile wiped off of the face of the options world forever, and everybody now clamoring for these out-of-the-money puts for protection and driving up the price tremendously, completely a supply and demand phenomenon and not any kind of mathematical one. Time and time again, people say, well, this is the way it should be. This is the way it should have looked. And I think that's insulting. It's insulting to all of the people like Myron Scholes and Fisher Black and Ed Thorpe and Mark Rubenstein and John Hull and all of the academics of the era of the pre-crash 80s, as if to say none of them knew what they were talking about and didn't know how to price options. That's absolutely absurd. It isn't that people just suddenly got smarter overnight. It's that people all of a sudden saw that they had to own these puts for protection, and something is worth what somebody else will pay for it. And so the sellers saw the opportunity to drive these prices up, and all of a sudden, the smile gets tilted. It not only gets tilted to go up on the left-hand side, but now people are saying, how in the world am I going to finance these puts? How am I going to try to get back some of this money so that it doesn't cost me an arm and a leg? And they look at the out of the money calls and they say, it wouldn't be the worst thing in the world if I go up 10, 15, 20% and I cap my upside a little bit. I'll sell some calls to try to at least generate some income and offset the cost of this protection. So at the same time that they're buying the puts and driving the left side of the curve up, they're selling the out-of-the-money calls and they're depressing the right side of the curve. And so the skew is born. And, you know, I thought at the time, and we're looking at a temporary phenomenon, and I was even lecturing to that effect. And of course, it's a permanent phenomenon, and it's 28 years later, and it's still there. If anything, from this starting in the upper left-hand corner and going down, you know, to the right with the calls, you may get to see a little bit of an upturn at the far right corner, a little bit of a hook on the end, and that is yet again, once again, anybody will pay a teeny to watch the monkeys play. You basically have that little upturn for the lottery tickets for the way, way above out of the money calls that may give you a little hook at the end, but otherwise it's the skew that everybody has come to know. So that's pretty much the evolution of it, and it really was quite a fascinating and interesting phenomenon, especially as it developed so abruptly, literally overnight from one day to the next in October of '87.
That is impressive, because I was going to say, I know someone's going to write in, but we've already just discussed it just now, that it was indeed an instantaneous transition. It wasn't something that we saw evolve in the subsequent days and weeks. And wait a minute, this shape looks a little bit strange. It was pretty much bam, and here we are in this new paradigm that has lasted close to 30 years since then.
And I wrote a little paper on it for Morgan Stanley at the time. I called it Looking Askew at Volatility, where I discussed all of these things that I'm kind of dredging up again today. And in order to make the point I can remember very clearly, I can see it in my head, I looked at the OEX, which used to be, you know, the S&P 100 and more popularly traded at the time. I looked at the OEX and it wasn't the skew, it was the smile, you know, like in September of 1987. And basically you had exactly what I described at the beginning, and no such thing as a skew back then.
I'll have to dig up that old paper and take a look at it. That'll be kind of fun. Unfortunately, we've already gone long, but this has been a fascinating conversation. Don, that's why I love having you on the show, because we can just go for hours about all these fun esoteric topics. Unfortunately, I'll have to leave it there. Not even a time for a crystal ball this week, even though all the downside bets we've been making of late seem to have been winning the day of late. But before we go, Don, you mentioned a lot of things cooking, about to come to fruition over there at Volex. Why don't you go ahead and leave our listeners with some teases, some hints of what's to come from you guys?
Well, I did mention the options and the futures, hopefully trading early 2016. And I did mention the new forecast that'll be on the website. I'll mention just one more thing. We've put up a new website, and it's called realvol.com, REALVOL.com. And there we shift the emphasis a little bit to the indices that we're going to be creating. We really would like RealVol to be kind of a standard for way the world measures risk on a multitude of assets. And so we are working on trying to create standardized indices that will use the Volex methodology, but on a very, very broad, you know, hundreds of different underlying assets. So we've kind of broken apart the index portion of the company or the business, created a new site called realvol.com, so listeners can take a look at that as well, and I think they'll find some interesting things there in addition to volex.us.
There you go, listeners, a new destination for realized volatility, realvol.com. Check it out. I'm looking at it right now as we speak, and a lot of cool stuff over here for you guys to play around with while you're waiting, like we are, I know, for the launch of these products. And before we go, Mr. Greasy Meatball, I know you're off there in the environs of Vegas. What do you guys have coming up in addition to Option Pit over there also at the new fund?
Well, the fund's going to probably do its first trade in November. At Option Pit, we're doing a vol primer. on November 7th. Go to optionpit.com/volprimer. And, we're going to cover all things volatility. We're going to look at earnings. We're going to look at how volatility moves, what really shapes volatility, and we're going to learn all sorts of fun things and how to trade. So if you are a trader not making money in options and you can't figure out why, the answer is probably volatility, and you should take the volatility primer.
There you go, listeners. Surf on over to optionpit.com to learn more. A lot of websites for you guys to visit this week. And on behalf of Mark and indeed Mr. Schlesinger, such a great treat to have him back on the show, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Look, you gave us 2 weeks worth of material right there on that one question. So keep them coming, and we'll see you next time for more Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.